everyone, and welcome to the Property Trio, the podcast for the sophisticated property buyer, and a very special episode, as we do every month. It's market update time. We are talking about the month that was October, and some pretty interesting things to dive into. Thankfully, I've got some industry heavyweights, some titans, actually very lean individuals. So the weight metaphor can't go any further than that. It's Dave Johnson and Cate Bakos.
It's good to be on the show and being described as a lightweight. Thanks for that, Mike.
Light in physical stature, heavy in intellectual and presence.
Love your work.
Industry titan to lightweight in the space of a sentence.
I'm just thinking, how bizarre can these intros get? And the answer is a lot worse.
So you're giving it a crack.
So let's cut the garbage that I started. I want to start with one big statement. The pace of growth in Australian home values accelerated in October, rising by 1.1%, the fastest monthly gain since June 2023. So even without a Melbourne Cup Day rate cut, we are still humming along pretty quick. Who wants to jump in first with October?
No, I think what you've just said is particularly interesting because Sydney and Melbourne for the month delivered 0.7 and 0.9 respectively. Might I just add that 0.9 is diminutive next to what Perth and Darwin have been delivering, but it's big for Melbourne. It's the biggest monthly gain that we've had. But when we have a look at, the ones that really are leading the pack, we've got Brisbane at 1.8, Adelaide at 1.4, Perth at 1.9, and Darwin at 1.6. The fact that the needle has moved so significantly nationally speaks volume for the sheer size of the bigger markets that haven't been pulling those big numbers.
Yeah, I mean, look, 1.1%, if we annualise that, we're now at an annual growth rate of 12%. So we're into double-digit territory on a monthly basis across the country. So we are just seeing a continued acceleration of price growth. And although Brisbane, Adelaide, Perth, the big movers of the previous 2 to 3 years slowed down significantly and some went into negative territory at the start of the year. As soon as the rate started falling again, we've had the 3 rate reductions. Those 3 capital cities have taken off again, which has been somewhat of a surprise to see so much life back into those 3 capital cities after they'd just about fully tapered off prior to that first rate reduction.
Yeah, we saw them galloping along. I think I once referred to them as the 3 horsemen of the apocalypse of growing house prices. Again, another awful and tangled metaphor in my style. But we kind of expected
Mixed
2025 they would sort of taper off, but still galloping away.
So just on that note, Perth did some overtaking of some other capital cities for its median value this month. So Perth has now in all dwellings moved up into 4th place, overtaken Canberra and Adelaide as a more expensive city. So Perth is now 4th, Canberra 5th, Adelaide 6th. In terms of houses, Perth jumped up past Adelaide from 4th to 3rd. Melbourne keeps sliding on down. Perth, is it eventually going to reach Sydney? Who knows? But it's continuing to make its way up the capital city ladder. And when we talk about these changing positions of the capital cities, I always think about that moving graphic that you shared with us, Cate. And what we saw is how, for 30, 40 years, we have seen capital cities slide up and down that order of the median value for them, haven't we? Like, it hasn't been a static thing across that journey.
Yeah, the only one that's always been number 1 is Sydney, but I remember when Perth got really close to it. Perth was number 2 and it was going so hard some 15 years ago.
Perth is going to face some headwinds, according to some commentators, especially in the iron ore side of things, with very weak demand coming from China. Short to medium term forecasts for a mild downward drift in the iron ore price, and global forecasts for $80 a ton, down from around sort of 95 to 105, that sort of range. So that'll be interesting to sort of test that hypothesis that Perth is overexposed to the mining sector. Obviously, it's just bigger than iron ore, but I wonder if that is the first sign of, okay, it might be set up for some time in the wilderness. And that was always, I suppose, the Perth cautionary tale that we were sharing. Of course, it's had a dream run, and if you were able to purchase there in 2021, 22, you've probably done well enough that, you know, you could probably exit and pay the stamps and the capital gains and have done okay. But it just begs the question, what's in store for the next 10 years? But perhaps another 6 or 12 months of growth is not impossible for Perth. What are we thinking?
Look,
your comment, Mike, about demand for iron ore from China, it's a big one. And I think any investor who has circled WA will absolutely be focusing on that and wondering about timing. And I don't like timing markets and looking at things short term, but you absolutely need to be well aware of the growth drivers and the things that can pull a location back economically, and that has to be playing on people's minds. If that continues, and it looks like it will from a supply demand point of view, and obviously trade relations, I'm not of the opinion that we'll continue to see Perth going gangbusters like it is.
What do you think?
Yeah, Tony? I mean, I think the demise of the price of iron ore has long been foretold, and it's very resilient. And you know, I've read some articles even just during the week of, you know, the iron ore mines being set up in East Africa, but how there isn't short or even midterm concerns about them really competing with the quality of Australian iron ore. So I'm not so sure about that. But look, the thing that ultimately stops prices rising is that they just become too unaffordable for people to pay. And that's going to come at some point in time. I do think, you know, by and large, Western Australian economy is pretty robust. So the question is probably just how long is this going to run for? History tells us that Perth won't stay up at, you know, the rankings where it sits as a capital city price point. It does go on these runs where it slides up towards the top. So look, I can't write it off in the short to midterm, because, you know, that's what it was looking like. It was going to finish its run at the start of the year, and here it goes again. So, yeah, it may, you know, in the scheme of 100 years of property prices, if it runs for another 2 years and then it's flat for 10 years after that, those next 2 years will seem like a big deal right now. But in the scheme of 50, 100 years of property prices, it's not that big a deal, if you know what I mean. Yeah. So we get so short-termism, and that's just natural for us to look and talk to that. But, you know, so I could see it's, you know, continuing to run for another year or two.
Yeah. So to give the summary of October, we're at 6.1% national growth for the year, 1.1 for the month overall, and up 2.8 overall for the quarter. And the month of October, broadly similar with capitals versus regions, although combined capitals for the quarter at 2.9, whereas regions are at 2.4, but the regions are doing better on an annual basis. So, I mean, it's the serial offenders, Brisbane, Adelaide and Perth, humming along. Darwin, as we've talked about, that's now at 15.4% annually. And really the first time we've seen Melbourne do anything terribly interesting for the first time. So nice to be seeing that what is happening on the ground suddenly being reflected in the data. Cate, you've been bloody patient to see that.
Oh, I've given up on my assessment. I just keep thinking I'm obviously seeing one segment of the market, because I've spent the year saying we're going to have, really strong growth. 0.9 is the strongest we've seen, but for $1 million property, that's a movement of $9,000. That is the way that I like to put it when I'm navigating a moving market, understanding that your comparable sales are resetting by that amount in a month that does that. But yeah, the data doesn't tell, the data does tell the full story, but this particular table is quite generalised, and we'll get to the segmented price points table soon, and that will give us a really good overview.
Yeah, we definitely will. Dave.
I just want to make a quick correction, because the numbers that have been put in my sheet here weren't quite correct in terms of where Perth sits. So it has risen for all dwellings past Canberra and Adelaide values. So that is the combined median for houses and units, into third place behind Sydney and Brisbane. Partially that's driven because they have less units than any other capital city, so that's why their all dwellings median is so high. In terms of houses, it did go past Adelaide. That puts it into fifth place behind Sydney, Brisbane, Canberra and Melbourne. So the order number I said was slightly out due to what's in this sheet, but it still moved up those rungs through this month.
That's good, Dave. We can't have you on Media Watch for incorrect data getting fact checks. So you've cleared that
right.
up.
Yeah.
Sticking with you,
I'm
Dave.
sure there are listeners out there who pay attention to those things.
Well, these are the people that we need at our live event to keep us all squared away.
Absolutely.
So check out the show notes. We've got a form to pre-register your interests, and we're going to talk about that as we roll towards the end of the year. Sticking with you, Dave, and maybe some commentary on the peak of the markets across the nation, and just with a bit of context. Obviously, we saw the inflation print a couple of weeks ago, or maybe it was early last week. Surprised on the upside, headline inflation 3.2. The RBA don't seem terrified about those numbers with some of the energy subsidies rolling off. They talk about not really caring about housing. It's all about inflation and unemployment. However, rents are a big component of that print, and rents have been hammering along pretty well. What are you kind of thinking for the property market? In some respects, it was kind of like another cut might have put even more fire under a market that is bubbling along pretty well.
Yeah, look, I think the market is bubbling along really rapidly, and that's going to likely speed up. In terms of if the RBA, which I think they don't want the property market to be, flying away, becoming too unaffordable, stoking inflation. And so, obviously not having another rate reduction due to those higher than expected inflation numbers I don't think it's going to slow down the property market in the short term, but it's not it's not stoking the fire further, if you know what I mean. I think particularly the 5%, the first home buyer boost, with only needing the 5%, not having to pay mortgage insurance, that has definitely stoked the market. And, there's different data points that are showing that already. And I think even this outcome of the largest growth in the month of October, which was a pretty significant jump month to month since 2023, is a sign of, I reckon, a fair chunk of that is due to that first home buyer boost. And what we've seen is much bigger changes in growth in the lower quartile and the middle quartile, where those first home buyers are playing, and where most investors are spending their money as well.
I was going to ask you about that, Cate, because we do have the capital cities via segmentation data. Is it too soon to see the evidence of that 5% deposit scheme in the data?
Yeah, it is, because this is 3 months of, it's quarterly. This chart is quarterly, and in fairness to it, we've seen the bottom and the middle quartile for most of the capital cities performing the strongest all year. And I think it's very fair to say that we've had a surge of investors in a lot of places, and that is the playground that they enjoy playing in. But I certainly believe that we will continue to see it supported and probably strengthened now with the 5% deposit scheme. And I'm on the ground, so I'm talking not just anecdotal, but experience-wise. And every single weekend, whether I'm bidding on a property that's a house within that 700 to 950 price range, or whether it's a unit with first home buyers on it, I'm seeing the impact of this. And I can't go up to every single bidder and say, are you a first home buyer and are you using the scheme? But if they're young and they're standing there with their parents, it's a pretty fair, dotted line to make. And I'm certainly seeing that. And I've seen markets, I've talked about this before, but house markets, not just unit markets, but house markets, in the sub 950 range, they're highly competitive. And the value growth that I've seen over a very short space of time, like let's say 4 or 5 months, knowing that this scheme had been brought forward and there were some investors who were wanting to beat it, so you can count them in the mix that's associated with the impact of this announcement. I've seen prices shift. We can look at areas like Sunshine West, for example. You know what the going rate is for a brick and tile 3-bedroom property on 697 square metres in Sunshine West, because there's lots of them. And, that price point has shifted markedly. And I'm very confident in saying that a large proportion of buyers that are targeting these houses are first home buyers who want a family home. And then you've got your investors, and all of a sudden 950 is a price point that you really need to be at or better in this market now, because the first home buyers are just grabbing them.
Well, and it actually has come through in the first month of data since it went live. So in the Cotality quartile data, there's been a bigger bump in the lower quartile. So the lower quartile dwellings were up 1.4%, the mid quartile are up 1.2%, and then the upper quartile just 0.7%. So even just in the first month of that going live, we've seen a bump in those lower and mid quartiles.
Interesting. That'll be an interesting one to watch, as we have, some markets that are still at peak and performing, but perhaps not at this pace that we've seen in the past. Like Perth is doing its sort of typical shape from left to right, lowest quartile higher and then the upper quartile lower, but the mid quartile seems to be accelerating. Darwin's that quintessential shape, but we've got quite a lot of activity in that middle quartile from Melbourne. So we'll be keeping a close eye on that. Dave, I prefaced rents as being a problem for the RBA at the moment, and they're a problem for anyone that rents as well, right? Because we saw 23, 24, double-digit rental growth in a lot of markets. The pace of growth then moderated, and it's had a little bit of a resurgence. Obviously, we've seen in the data that we've had a bit of an exodus of property investors. And for those that are saying, removing all property investors would be great for the property market, we're probably getting a little bit of a thought experiment on, okay, well, what if a few of them left? Like, what actually happens? And I think the result of that is that rental growth. The shape of that worm, especially for houses, it's a bit concerning.
Yeah, and I that may have been part of why it's occurred, but now investors are coming back, and they're coming back at a rapid pace. And APRA, probably a lot of people may not have seen this, but APRA produced some numbers in the last week on this, and they're actually now getting concerned about the number of investors in the property market and talking about the potential for macro prudential regulations again and curbing interest-only loans and investor loans. So we don't have the lending data out yet, but APRA brought out some data that and has warned that investor lending growth has hit a 10-year high.
Wow.
And do you think APRA's concern, Dave, is primarily around house price growth being fueled, or is it protecting first home buyers, or a combination of the two? What do you think the background to that is?
So what have they said? Like they don't want too many investors in the market crowding out home buyers is my understanding, and so it's bumped up to 38% of those getting finance mortgage lending is for investors. The long-term average, you might say 33, you might say 35%. So when it was right at its peak, and this is a number I track each month, it was at 46%. So new investor home loans increased by 0.77% in September. That was the highest monthly rise since June 2015.
Wow.
Interesting.
So that's not
there are lots of things that are bringing investors back. There's share market volatility is a concern. Intergenerational wealth transfer is on the increase, so people have more money. We've obviously had some really strong gains in certain markets that haven't, particularly Perth and Darwin, they haven't had big gains, so there'll be people there that have equity and want to do something with it. I wonder, though, what other forces are fueling investors to turn to bricks and mortar?
Yeah, I would say rates getting lower, so it being more affordable, and then people wanting to get in before all these first home buyers get in and push up prices because they think they're going to get a guaranteed gain in these price brackets where all the first home buyers are going to be buying over the next, year or more. I'd say they'd be two big drivers. I don't know if it's a coincidence that it happens just the month when they announce they're bringing forward the first home buyer scheme to October 1st. Is that a coincidence, or did that cause some investors to take faster action? It was prior to most of that would have been prior to the inflation surprise coming out. So a lot of people would have been expecting another rate reduction in November as well when they were taking that finance out. So,
Cate, a trend that we've observed and talked about is that we have a popular market, let's say Perth, with heavy investor involvement, and then we see rents increase, and we kind of think, okay, well, if supply and demand is an immutable law of the world, then rents should really go down as we have more people participating. But arguably, we see when new investment properties purchase, those properties maybe return to more a market rent, whereas if it's an investor that's been active for 3 or 4 years, typically it would be under market rent. So I wonder if we're seeing that in some places. But as an example, Hobart, at 6.8% growth in second place. I wonder what's at play there. Is this an early blip where we may be seeing some new investor activity in what is a very cheap market that some people will say it's its turn?
Yeah, I wasn't quite sure about this. The only thing that I can think of with Hobart is that we've had a lot of investors sell up and they've gone back into the private market, and the number of investment properties available for rent has diminished because we saw a lot of Melburnians and actually mainlanders purchase in Hobart, in Tasmania, when rates were really low and COVID lockdowns were biting, and holding a holiday house these days is pretty hard. And the idea of having a serviced Airbnb down there, now that domestic travel has been overridden again by international travel, maybe the appetite's just not there for Airbnb holders to at one point in time, it was very hard to get an Airbnb down there because we had no overseas travel permitted. We were locked into this island, and we saw a lot of domestic travel and people making the most of enjoying something different down there. So that's the only explanation that I can think. We've seen a lot of investors and Airbnb holders sell into the private market. They've gone to owner occupiers, and there's still resident tenants down there that need a roof over their head.
The property... Sorry, Dave.
Well, I was just going to ask you too, how much do you think, and it obviously varies from state to state, but some of the restrictions being placed on landlords, you know, you can only increase your rent once every 12 months, and, you know, some of the, you know, the tighter rules around being a landlord and more freedom to the tenant is causing landlords to go, okay, this is my opportunity to bump up rents, and I'm going to bump it up a bit more than I would have otherwise because I'm being more tightly regulated. I don't know if other rules will change between now and my next opportunity. Do you think that actually feeds and has an, you know,
Yep.
The opposite effect that the governments are hoping for when it comes to at least rent increases, and that's feeding into it?
I completely do, Dave. We've had this argument, and it's a very, I've got to be careful with my words here. When your holding costs go up, you can't just put your rent up. That's increasing rents is based on market forces. You can really only increase your rent when there's an opportunity to do so. However, there's a little bit of malleability in it, as you're alluding to, because you can be drifting along on a comfortable rent, and your property manager says to you, Cate, you know, this time round, I don't think we can put the rent up. You've got a good tenant. They haven't really moved. Let's just leave it at, you know, $480 a week. And I say, for sure. When things are really biting, I'll be on the front foot. Are you sure it can stay at $480? You don't think we could go to $490? Oh, well, you know, yeah, probably it's $10. Let's give it a go. Those conversations will definitely be happening. And in addition, you'll have a lot of landlords that have been like I've been, where you are happy to keep a great tenant there. It's $480, and all of a sudden the rents are moving. Your property manager says, actually, you know, Melbourne's had some really good rental growth. We're probably underdone on your rental right now. We should put it up. And I'll say, well, what do you think it should be? Well, actually, you could get $530. Okay, bang, let's do it. You're getting landlords saying that now, rather than saying, oh, let's just make it $500 because they're a really great tenant. The great tenant bit, it can only float for so long. When a landlord is really feeling the pinch, they will take the opportunity to get the market rent that they can get.
Yeah. So you think that will play into...
I think it's happening.
Oh, sorry, go for
100%.
it, Mike.
Yeah, that was way more eloquent than what I was going to say, but it was roughly going to be the same thing. I remember growing up in country New South Wales, we were on tank water and it was getting low in a dry period, and Mum said, you know, don't use too much water because we're running low. I've never been thirstier in my entire life. You know, it's just a psychological thing. It's like, well, you know, when you can't be touching it, you think about it a little bit more. And when you know you can change the rent at any time, you tend not to worry about it. You're like, oh, yeah, like, you know, I've got flexibility that if I need to do it, then, you know, I'll do it. But when you know you're locked into once a year, you're like, okay, well, I get one go at this, so we're going to be right on it. So unfortunately, that is the unintended consequence that we see when we have policy decisions around the property market. I don't think the policy makers fully understand the unintended consequences of things like the 5% deposit scheme and investors jumping in because they see that segment going through the roof. You know, the people that are not qualifying for that scheme or just not ready, it's harder for them when maybe they are going to be ready in a year or two's time. So, I definitely think that's a factor.
Yeah. And you combine that with the lowest vacancy rates on record, and you get what we've got, and that is a significant contributor to the inflation.
Yeah, absolutely. So in terms of summary of rents, so the unit rents rising faster than house rents across most cities. Combined Capital's rental index recorded a 4.4% rise for units over 12 months and 3.9% for houses. So we're talking an extra $28 a week added to the to the median, and 27 a week on houses over the past 12 months. So I feel like it's biting people. And I was going to say before, our esteemed former co-host and property professor Peter Kalizos shared that research of rents not outperforming inflation over a 25-year period. However, when we're looking at the data, there's really probably only Melbourne and Canberra sub-inflation levels of rental growth. Everywhere else is blowing it out of the water. And we're starting to see some more meaningful and more juicy numbers when it comes to yields across the country. Adelaide, Brisbane, Melbourne, on the lower side, Sydney at 3%. But, it sort of seems like 4% is maybe the new normal, but still pretty low yields given the pace we've seen of capital growth, right?
Yeah, well, we all know that yields oscillate, and you've mentioned that sub 4 seems low, but Melbourne at 3.6 is pretty high historically for Melbourne. Sydney's at 3. We've seen Sydney in the 2s. So everything's up a little bit as far as that oscillation goes. They're on the higher end of normal at the moment.
They're starting to fall somewhat now because capital growth is out. Even though rental growth is so strong, capital growth is starting to outstrip rental growth again.
Yes.
Well, when we're wanting to look at the strength of rents, we don't have to look too much further than the vacancy rates, which are still very, very tight, aren't they?
Yeah, exactly. And that's what's feeding into, a key factor that's feeding into this rental growth. Which we've had 0.5% rental growth over the past 3 months across the nation on average. And so that's the highest since May 2024. So that's the highest speed for 18 months with rental growth. So it really is picking up again. And just a little interesting data point for Northern Territory. The ABS data shows investment housing loans secured have more than doubled over the past financial year across the Northern Territory.
Wow.
Yeah, wow.
Which obviously explains the very strong market conditions. Yeah, vacancy rates, historical lows, 1.2%. Is there anything of note in there? It looks like most of the numbers for the vacancy rates, Canberra's gotten tighter, dropped from 1.6% to 1.4%. So even less rental properties available for Canberrans. So they'll be seeing their rents rising further probably. And Brisbane slightly eased, but still, such a low vacancy rate at 1%, slightly up by 0.9%.
And Cate, you hit the nail on the head with Hobart. October 2024, we had 179 vacant properties in Hobart. Now we're 107 vacant. So again, small sample sizes, but that's a big cut. That's a big cut.
Yeah. Huge cut.
I mean, only 107 properties available for people to rent in the whole city.
Yeah. It's not a lot, is it?
No.
All right. Sales and listings. Let's stick with you, Cate, on the sales front. We are seeing a nice little trend upwards, and we've sort of bumped above our 5-year average in the last little while.
Yeah, we sure have. And we've had a few that have really kicked on. In fact, we haven't had too many in the negatives. Change in sales volumes over 12 months. We've had Perth, Brisbane and Sydney just pull back a little bit, but we're talking sub 5%. We've got a surge in regional Northern Territory, which is a little bit of a surprise at 30.8%. Regional Vic, 24.4%, and regional New South Wales at 9.2%. But the one that's had an enormous surge is Darwin at 57.7%. Canberra is above 10%. And Melbourne's sitting at 8.8%. So a lot more sales activity in all of those markets, but obviously Darwin's just, smashed it out of the park.
Yeah. And so this is a good chart to watch for our listeners, because historically when prices rise, then the number of sales rise, and no surprises, obviously more people wanting to buy property which tends to push up prices. So looking at where the sales numbers are starting to trend upwards, you're probably going to see prices trending upwards at a faster rate as well. And we're seeing that trend nationally, which I think, notwithstanding the fact that the RBA, the next rate reduction, who knows whether it's going to occur or not, or whether the next move might be up, we're still on a trajectory of the nationwide property markets growing in value at a rapid pace for the foreseeable future.
Yeah, I agree.
To have a sale, though, you need a listing. And the supply of listings, it's been a big month for listings. The monthly change across every capital city and territory is up nationally, a bump of 10%. Yearly, we're still kind of seeing pretty flat numbers. But what do we think is behind this confidence, I suppose? Because the impediment to listings can often be, okay, well, where do I go if I sell? And nobody wants to sell at a loss. When we have most capital city markets at the peak of the market, there's more confidence that you're probably locking in a gain. What do you think, Cate?
I think vendors have been waiting for the best time, and they've been holding out for when the interest rates will drop. And now that it's obvious that we are at that lowest point, most likely, or we're at equilibrium, they're all saying, okay, well, now's the time. And they're getting confidence fueled by an increase in listings because they've got more to choose from. And also you'll have some vendors, like investors who want out, who are looking at their markets and saying, well, I'm going to get a pretty good gain, so now's a good time to sell.
Dave, when we look at the yearly change for property listings, it does tell a little bit of a story, although when you see Brisbane at negative 7.3 and Adelaide 9.5, those markets seem to be sort of performing quite similar, but the listings are very different. And then, of course, Darwin at that contraction of 31.5% to negative listings over the year, that obviously speaks to the strength of the numbers that we're seeing there as the competition builds, right?
Yeah, I mean, the two key numbers are going in opposite directions, which is just pushing up prices even faster and rents, it would seem, in Darwin, where you've got record numbers getting finance, record numbers buying properties in Darwin, but I don't know whether they're record numbers or not, but hardly anyone was selling property because they think there's further to go and they don't want to sell now while the going's good. So, yeah, you've just got such disparity between supply and demand in Darwin, and that's driving prices up significantly. And, it seems like people have pulled back on putting their properties on the market in Brisbane again now that prices have started to rise quite rapidly again since the rates started falling.
Yeah.
Cate, I always get excited with these listing tables every month, and then you normally tell me to calm down because the sample sizes aren't very big. Ignoring that statistical impediment, wow, look at old listings down over 50% in Darwin. So, that speaks to a fever pitch. And as you've sort of said in the past, that's possibly some of those ugly duckling properties that don't sell in a balanced market are flying off the shelves right now.
Yeah, that's right. We're seeing all of their old listings eroded with just sheer consumer demand.
And when we look to the distressed listings, and that's the one where we probably suffer from the least sort of robust data just with the sample sizes, it's interesting to see that ACT is really the only place that has seen a big yearly increase in distressed listings. Everywhere else is, double digits into the negative. Do you feel like there's enough for us to read anything in that number?
No, the only thing on that table that I'm really paying a bit of attention to is it's not ACT, even though that yearly change is big, because we're talking about 41 properties, so tiny sample size. But looking at South Australia with 239, what's got me scratching my head is the monthly change of 26%. What's made 26% of those vendors become distressed? And like 239 is not a massive number, but that's quite a few households in 1 month that have tripped over to distressed listing. And I wonder what's going on there.
I mean, you could guess and say Adelaide prices have gone through the roof for a number of years, and some of the locals who've been caught up in that have bought properties that were outside of their affordability from a debt perspective to get on board, and now they can't afford to hold them, and so they're having to sell them under distressed circumstances.
Yeah, I think it's likely to be coincidental, and it could be personal circumstances, but it does make me wonder what would make a number
maybe a
pop
spring
up like
market.
That,
you've got more properties being sold in spring, and so that number might just historically bounce up around spring.
Yep, could be.
When we look at it more broadly in terms of stock levels, yes, we have a lot of new listings coming on, but we've had a lot of sales as well. So is it fair to say that stock levels are still somewhat depressed?
Yes, if we have a look at all listings on the Cotality table, you can see that that's tracking significantly below the last couple of years and the 5-year average. The new listings numbers, they're looking good, but all listings, that's definitely lacking.
They're coming on and they're exiting as quickly as they came, pretty much. So down 14.3% compared to the same time last year, and almost 20% below the 5-year average. So it's pretty competitive out there. What are we seeing, Dave, across different locations in terms of those stock levels?
Yeah, so in terms of those stock levels, we're seeing new listings change from the equivalent period last year. Perth's just fallen away. It's got 28% less stock, which is a huge number, which is driving its prices up once more. Then Adelaide at 12%, fallen, so less stock. Darwin, 10% less stock available. New listings. Brisbane, 8% less. So, that's certainly correlating with those 4 capital cities, but having the biggest growth numbers over the last month and last quarter. Whereas Melbourne, we've seen, and Sydney, we've seen new listings jump. So that's interesting. I'd say people are feeling like they're more likely to get a return on their money, plus it's spring, but then again, it's from 12 months ago, so it's comparing, spring this year to spring last year. So perhaps people are now saying, okay, well, the market's rebounded. We're back around the mark of where we were when the property market was at its peak. We've talked about Melbourne is give or take at that mark. It'll hit it in the next month or two. Sydney's just gone past it. So people are probably more confident they're going to get a reasonable price. And as we've talked about before, people look at, okay, these properties were around my area were selling for this mark 2 years ago, and they've only just got back there. Okay, I'm happy to sell now because I'm going to get what I would have got for my house 2 years ago. Whereas, in Melbourne and Sydney, they've probably been holding off for a while going, I don't want to sell for less than my neighbour sold for 2 years ago. And so they've been holding off. So that probably feeds a bit into the Melbourne and Sydney numbers increasing year on year, the new listings.
Okay, Dave was talking about sentiment there, and we are pleased to report we've got the consumer sentiment data hot off the press for November. What was illuminating for you when checking that out?
These were weird numbers.
Yeah, they're big jumps. We've got double-digit jumps on just about everything. So family finances over the next 12 months, economic conditions over the next 12 months, economic conditions over the next 5 years, and time to buy a major household item. All of those are double-digit. And that was a bit of a surprise in just 1 month to see that shift. Time to buy a major household item, which I've always kind of called toys, that's at 15%, but over the year it's above 30%. And I think interest rate increases settling down I think a lot of people aren't fearful of increasing rates. They either think that the status quo is where we're at, or we've got a chance of further rate cuts. It has stimulated people, feeling comfortable about buying toys. And the other one that was quite strong was interest rate expectations index. That's up 17% in 1 month.
Dave,
Really surprising.
I think so too.
And just as a bit of context, the survey was conducted in the week from the 3rd of November to the 8th of November. Now, the interest rate announcement happened on the 4th of November, so that probably discounts some over-enthusiastic people in this sample, because the majority of it would have been done post that date. What can explain this optimism, Dave? Black Friday sales coming up, or who knows?
I'm not sure, because obviously inflation was higher than expected, and we went from a reasonable likelihood of a rate reduction to no rate reduction. So you'd think it would have caused sentiment to turn slightly negative, but we had one of our biggest jumps for some time. So maybe, I can't really put my finger on why it turned so positive, given that higher inflation. Maybe it's people just don't pay attention to that level of data, and it's just, feeding off the back of the 3 rate reductions that have already occurred this year. Seeing property prices grow, seeing the share market fly. We've got more money invested from retail investors into the stock market than ever before. And so it's perhaps the accumulation of that versus the fact that, we went from seemingly getting another rate reduction to, possibly a next move will be up, because it's really hard to explain. It's a somewhat surprising result, but if you exclude the COVID disruptions in 2021, it's the most positive result for consumer sentiment in 7 years.
Yeah, wow. Well, people are chipper. I mean, there's nothing wrong with that. Let's not rain on their parade. It's just a bit of a surprise, especially after the rate cut. But I suppose the commentators have said the RBA announcement and the meeting minutes have spoken about this as more of a blip than a trend that they're concerned about. Maybe that feeds into that print.
Yeah, I mean, the economic outlook next 12 months and next 5 years jumped sharply, 16.6% and 15.3%. So, people are feeling pretty good overall about their finances. It would seem, despite the fact that, as it keeps saying, the inflation was higher than expected, and we might still have those cost of living pressures for longer and may or may not get another rate reduction. So, I mean, maybe the 5% boost, that was really positive news for a large cohort of the population. Maybe that was a big reason for the jump as well. That feeds a little bit into the detail of the time to buy a dwelling index. It's at around 96.5, but what's quite interesting was the widening divergence across age groups. So the read was 115 if you're aged between 18 and 34.
Right.
About being a good time to buy a dwelling. Presumably a large chunk of those are first home buyers who are eligible for this first home buyer boost. Whereas if you're aged 35 to 50, it was 87. And if you're aged over 50, it was 84. So, maybe that first home buyer guarantee being brought forward fed into all these numbers bumping up somewhat.
Yeah, I always love their commentary. I mean, you've got Westpac putting out this press release, and they said, it was a markedly more confident assessment of prospects for the economy. The RBA decision, it seems, was less unsettling than feared. We noted at the time the bank could have sent a more hawkish message on inflation than it did. Instead, it assessed that some of the recent rise was due to temporary factors, and the governor also revealed that the RBA had not considered raising the cash rate at the November meeting. So for a lot of people, you see all of these different articles and suggestions in the media that we might have, we could be switching to an interest rate increase environment, I think that the governor's message did soften that blow, and no doubt people have responded to that.
Yeah, yeah. And the reality is most people are only taking in a snippet here, a headline there, and, not all of the data that we go through. And so it's a matter of what are those headlines that get through to the vast majority of people.
Well, they should be listening to our show, Dave. In fact, if you are listening and you have a friend that's a prospective first home buyer or an investor, then send them a copy, because I don't think many people are diving in as deep as we are. And, why shouldn't we be? Because we've just seen from Cotality's, their chart of the month, Australian residential real estate rises above the $12 trillion mark. As an asset class, it's bigger than anything else. And that chart, interestingly, shows where the proportion of that real estate sits. So New South Wales, Victoria and Queensland, no surprise, dominate that value there. But, the majority of it, say more than a third of it is New South Wales. So that's an interesting one to notice. Were there any takeaways from you guys?
I just think the weight of the chart, as you've just said, Mike, it really explains our national growth and the headline reports that we see. We're all saying Darwin's leading the pack, but when we have, and I'm not downplaying the importance of that, but when we have a look at the weighting of properties across the nation, it's so tiny. It's at 0.4% for Northern Territory versus 38.6% for New South Wales and 23.6% for Vic. So those big juggernaut cities, they definitely move the dial or don't move it when it looks like other cities are going gangbusters.
Yeah, if we want to have a headline about the national property market soaring, we do need New South Wales to be doing something, right, because of its share of all of the housing.
Yeah, right.
And we've often talked about Melbourne and Sydney are about half the property market. And I can't see that chart, but was that Melbourne and Sydney was 60% combined, or Victoria and New South Wales?
As far as dollar value goes, Melbourne plus Sydney is
61%. I think you said 38 and 23, give or take. Yeah.
Yes.
So
and if you have a look at the position now in 2025 versus 2020, you can just see how far back Victoria has moved. I mean, they've had huge value losses on that percentage scale, and New South Wales is not modest either. It's WA and South Australia and Queensland that have, really moved positively.
And I'm sure this podcast has shared different shows in the past about, do house prices double every 10 years or 7 years? But this data was showing that more than double the value of housing than we saw a decade ago. Of course, we've got different populations and different numbers of housing, but certainly the growth is pretty solid.
Yeah, is it ever?
All right. Well, we've packed a fair bit into 52 odd minutes in the last little while. Are there any takeaways that you wanted to share? I know you had some insights into lending data, Dave.
Well, look, I shared that, just brought it in where I thought it was sort of suited to talk about the APRA warning and the investor lending growth. So I'll just quickly share, they have cautioned banks that so this is sort of a shot across the bow. It's little things like this to watch out for that could end up causing a property market to slow down. So they may activate macro-prudential tools if investor lending continues to surge. So they've said the tools that are under review. So this is a big thing. If they bring these in, it will change the trajectory of the property market. Yep. Limits on new high debt-to-income loans, caps on investor or interest-only loans, which they did to great effect in the past. And they're going to monitor these trends closely, and they're concerned such conditions historically lead to higher leverage, riskier lending, and rapid price gains. Now, it feels like they're jumping in pretty early here from my perspective.
They're giving the banks a warning, aren't they?
Yeah.
they're giving the banks a warning. It feels like 2025 again, when the lenders were like, yeah, okay, whatever. And then in 2015, when they gave the banks, they put them on notice. And then in 2017, things got really tight. And we won't forget that credit crunch, just really ground things to a halt, and it wasn't great across the board.
Yeah. Hopefully that doesn't happen in about 2027.
Yeah.
Well, we've already got a differential in interest rates for owner-occs and for investors. I remember when I first started investing, there was no real differential. It was all the same. And now we've held that firm for almost 10 years of different rate, whether you're an owner-occupier or an investor. And I think that's the lever that the banks can play with rather than prohibiting credit.
And interest-only loans used to be the same as principal and interest loans, but they're different now too in terms of the rate you pay. It's not significant difference though.
Yeah.
Taking one thing out of it though.
They are. Ruin all the fun. I thought it was really interesting that we've now got an agreement that we'll get a monthly measure of CPI, and that's so good for so many reasons. That the RBA no longer have to, wait for that critical announcement, and they don't have to worry about how they take the temperature of the market. They'll have that in real time at their fingertips. Well, it's not really real time, is it? But it's monthly, which is better than quarterly.
But then they also have less meetings this year than they did in previous years. So less opportunities to act, but maybe better data to act upon. I wonder how that balances out.
Well, at least they can see a trend rather than getting, belted with a figure every 3 months.
Yes. All right. Well, if there's nothing
I think it's
else,
unlikely to be a move until perhaps the May meeting, until they've got 2 more full quarters of data one way or another.
Yeah, and Christmas is always a very good litmus test on how willing we are to consume and spend as well. So that'll be interesting to observe, along with the Black Friday sales, which never seemed to be a massive thing in Australia, but seems to be much more of a factor than it has been in recent years. All right. Well, that was October, and coming up, we've got a few pretty exciting episodes in the next month or so. We're going to have to review the year that was, which includes our predictions, which will be, glorifying and edifying for some, and terrifying and soul crushing for others. Maybe both in the same episode. We're also going to talk about our 2026 predictions as well. We're going to have listener questions. We've got heaps of stuff, so keep signed up and tuned in to the Property Trio, but we will see you again next week.
Yep, and if you've enjoyed the market update, please share it with a friend. It is our most listened to episode.
Cheers, guys.
See you later.
Thanks, everyone.